Welcome to Rise Up, where we take a look at the biggest stories each week. We break them down to help you understand what's happening in the markets, and there's a lot happening right now, but it's really about growing and protecting your portfolio. I'm Terri Kallsen. I've spent my life in financial services. I'm a certified financial planner. I'm a managing partner at Rise Growth, and I'm also the chairperson-elect at the CFP board. Joining me is my co-host and managing partner at Rise Growth, Joe Duran. He's currently the CIO at Rise Growth. He's a former partner at Goldman Sachs, and he's also a CFA, a chartered financial analyst. And we have another guest, Scott Schwartz. He's a principal at Bleakley Financial Group. He's a wealth manager and a certified financial planner for over 30 years, working with clients to help them achieve their goals. Welcome, Joe and Scott.
Hi, Terry. How are you?
I'm awesome today.
What a week, huh?
A
Woo.
week. Oh my
Yes.
gosh, what a lot happening. We've got a lot to cover. I'm really excited. All right, let's get to our top three big stories of the week. The first one, we have a new president in the office, and he's been busy this week. Lots of policy statements, making
Wow.
decisions. What are your thoughts?
Well, look, we're going to talk a lot more about some of the things, but it's very clear we have a new president in charge. There's clearly from the top level a very different approach to how we interact with the world, a very US-centric approach. I think there were three big things he spoke about. I know we're going to talk more about them. The first one was this idea of fighting inflation, leading with how we deal with oil prices, and how he's going to demand that interest rates go down. I'm not sure how he does that, but that was the first one. Second one was there was a lot of talk about tariffs, and that has a lot of implications for investors. And the third, potentially lowering taxes more, especially for corporations, all of which have huge implications for not just everyone watching, but all investors in many different industries in stocks.
Yeah, he's got a lot on his mind, right? I mean, he also talked about Saudi Arabia and OPEC reducing oil prices. He talked a lot about investing in AI as a new venture called Stargate. So a lot going on. Scott, I'd love to hear from you. The markets are clearly reacting to this. JP Morgan CEO Jamie Dimon is saying that the S&P is overinflated. What are investors to think right now?
Well, I think there's a lot going on out there right now. I think you have a lot of people that are very optimistic, and I think there's reason for optimism. Less regulation, lower taxes, this America first, sort of sentiment, I think has got people motivated. Not to sound schizophrenic, but I think Jamie Dimon also has a point. 22 times on the S&P 500 is a pretty high multiple. Rates seem to be a little bit sticky here. A lot of people, I think, are hoping rates are going to go down. We're not so sure the rates are going to go down as quickly as people think. So, yeah, I think that the market's a little expensive. I think there's a lot of reason, like I said, to be optimistic, big picture wise. But I think, as Joe said earlier, I think we might have a little bit of volatility going forward. There's a lot going on.
And 22 times on the S&P as overall, that means there's some things that are 10 or 12 times, and
right.
some things that are much, much higher.
That's right.
And that's the thing that I think you have to keep an eye on. The Mag 7 stocks are at really high levels of valuation, the kinds of things we haven't seen since the late 90s, early 2000s.
Right.
And again, they're so priced to perfection. Now, a lot of things might work out well. AI is going to have unquestionably huge impact on everyone. But we also have priced in a lot of good news and are paying today for a lot of good news going forward. And so I think this coming week with earnings coming out could be some big surprises. But we are starting to see some bubbles in the marketplace. You're going to have to be very selective here. And I always think when you have valuations priced to perfection, people today are looking for reasons to buy, but it doesn't take a lot for people to suddenly go, hold on a minute. Am I being too optimistic? And the good news is there's still trillions of dollars of cash on the sidelines that are still concerned, still worried about what it meant for a change in an administration. And that money is also a buffer. So again, I don't think you're likely to see an immediate drop down. I think you see more volatility, and then that cash could also come in to invest on things that are beaten up. But I think you want to look at as I'm sure we'll talk about in a sec, what strategy you can take. I think you want to, if you're investing now, make sure you look at the valuation of the stocks you actually own.
Yeah, when I hear you and Scott talk, it's optimism, right? But a realism around volatility and really understanding what your goals are and your risk tolerance. Again, we talk about that a lot, but it's important not to think of it just week to week, but what is your overall long-term plan?
Yeah, 100%.
Well, let's get to topic two. Gosh, February 1st. You know what? That's my son's birthday. I'm pretty excited about that day,
Well,
but I'm not
congratulations.
sure.
I'm not going to ask how old he is, Terry.
Yeah, let's not talk about that. But February 1st is a happy day for our family, but it may not be for Mexico, Canada, Russia, and China. President Trump is saying he's got a deadline of February 1st, and he's really putting pressure on Russia to end the war in Ukraine, for all the others to think about what they're doing to stop the drugs coming into the United States. I mean, there's so many potential outcomes here if he does do these tariffs. Joe, what are your thoughts?
Well, I actually am quite a lot more optimistic this week than I was just a week ago because of the framing for tariffs. It's basically, we're going to use tariffs as a negotiating tool to get better terms for the US. It was more opaque and vague before. It sounded like it was just going to be blanket tariffs against countries that we think are taking advantage of us. And there was some talk of that. But actually, it's quite different to have a conversation about, hey, listen, if we have a trade deficit with you, we're going to try to even the balance. If we're spending more money than you are on your products, we're going to have a conversation about how to even the balance. So it does appear, again, who knows how it gets followed through, but there appears to be a more thoughtful approach about how to use this to bring our trade partners to the negotiating table. And if it is done that way in a measured, calculated way, I'm not sure it actually leads to the concern I had about inflation, overall counterbalancing, counter tariffs, which increases prices for everybody around the world. So again, targeted tariffs with a very explicit outcome desired makes it a very different conversation than we're just going to slap tariffs on everything. And so again, I actually felt quite optimistic. He was quite typical President Trump approach. I'm going to make a lot of statements and go everywhere, but I actually thought this was quite a thoughtful way. Clearly, the markets felt good. As he spoke more, the market actually reacted quite well. So I actually felt quite good with the approach. And as long as it's followed through in action, which is not always the case, as we've seen, I think we can actually, as investors, feel pretty good. Now, it does matter where is he applying tariffs, in which countries, what are the implications for consumers and for the stocks that participate there, because taxes are not paid by countries, they're paid by individuals and companies. So again, don't be blind to what's happening. But again, as an overall tax to the economy, I think it won't necessarily be as bad as I was imagining a few weeks ago.
Yeah, I think so too, Joe. I mean, one of the things that we want to accomplish with our viewers here is help them with discernment, right? There's a headline, and then there's really, how do we discern what's actually happening here? So we've got attention on tariffs, but in the end, the outcome might actually be very good, potentially. Ending wars and reducing drugs in the United States. That might be a right outcome, but we have to discern.
And increasing investment in the US.
That's
Like,
right.
again, if we can convince, because we're talking about applying tariffs on a product, that product should also be made in the US for 50% of the manufacturing, that's good for us. It's good for the dollar. And I'm not sure the impact on inflation yet, because, of course, we don't have a lot of excess labor in the US right now. But again, it has implications for everyone that might be good for the economy. And again, we might be able to absorb it relatively well.
That's why I love doing this show, is we can help viewers really start to understand and make better decisions. And that's why I'm here every week. And I know that's why you are as well. So let's go on to our third topic, and this is a pretty big story in its own way. There's some big changes happening in our IRA rulings. I've got to make sure I don't trip up those letters. IRA, Individual Retirement Account, in case anyone needs to know.
And most people here, I think, watching probably have a 401k, and certainly it'll at some point roll into an IRA, which is an individual retirement account that, again, originally for many folks started inside the corporate 401k, and then when they retired, rolls into an IRA. And basically a tax-deferred way to take your savings and invest them.
Yeah, that's a great way to explain it. But there were rules that, were enacted over 5 years ago but they're really starting to be enforced here in 2025. And I wanted all the viewers to really know it involves inherited IRAs. And if you're a spouse or an underage child, disabled or chronically ill, unless you're those, you would be forced to withdraw this money from your IRA. And it's really a 10-year rule, right? And this is a pretty important financial planning topic, right? Because if you're forced to take out money from an inherited IRA, what happens? Your income goes up and you probably pay more taxes. And if you're not really aware of this, you may not understand the implications. And so, Scott, you're a CFP. This could have a big impact on non-spouses and adult children. What are your thoughts on this?
Yeah, we actually have a lot of clients who've got inherited IRAs. So we spend a lot of time talking about distribution plans. So the idea is that now you're forced to take the money out over a 10-year period of time. Doesn't have to all be at the end of the 10 years. It doesn't have to be uniform. You kind of have some flexibility here, which is probably a good thing. So from our perspective, we spend a lot of time talking to our clients and helping them understand it's important to be thoughtful about it. So for example, a lot of people are under the misconception that I want to defer my IRA distribution as long as I can because people are so tax averse. But the reality is what you really want to pay attention to is what is my tax bracket this year, next year, the next year. You might be in a situation where you have losses from a business or some other scenario where you might be able to use those losses, in which case maybe you want to take those distributions early. You want to pay attention to what that distribution in the IRA that will be ordinary income, what does that do to impact your tax bracket? So I think the best thing people can do is sit down with their financial advisor, understanding that I've got this inherited IRA. It has to come out over this 10-year period. Can you sit down and help me understand what would be the best time for me to take this money? What would be the best schedule to withdraw the assets? I think that's what we focus on.
I think it's, sorry, Terri. Look, I just know for myself, these are the kinds of things I'm just never on top of.
Right.
That's why I have an advisor too, even though I know a reasonable amount about investing and all these issues, it's hard. So having somebody at your side who actually says, hey, don't take it this year because you're going to go into a higher tax bracket. And of course, it depends on the state you're in and what your income bracket is. So again, having strategy around how you distribute matters, but it also obviously has a big impact. If you have to withdraw it in a 10-year period and what process do you use, it does take away some flexibility that people were using here of just keeping them as long as possible, growing in a tax-deferred way. Right. And now that cannot be done. And now you have a fuse running if you're not, unless you're in one of those exempt groups you mentioned, that you have to take that distribution.
But I would just say, Joe, just on that score, it's not necessarily a bad thing to take money out earlier. Right. Because remember, we're deferring that money later. It's going to be a bigger amount of money. It's going to be ordinary income taxes. It's got to come out at some point. Then people will start collecting Social Security, maybe have pension payouts, depending on what they're doing. So again, it really does make sense to sit down and figure out where am I now? Where am I going to be, in 5 years, 10 years, et cetera, to come up with a plan, if you will, to best utilize that 10-year period that you've got.
Yeah, I think, Scott, you've really just punctuated the most important plan. Have a plan, right?
That's right.
It's happening, we know it's happening. If, you're a non-spouse or an adult child, do you even know what questions to ask? And having an advisor can prompt that for you. And so, that's critical for people after leaving the show to take action on that.
Right.
So let's go on now to the big questions of the week. Remember, we ask our viewers to share questions with us and to share with us what's on their minds. And so there's been so many big changes this week, but our first question is really for Scott. And Scott, what's the best advice for managing my portfolio in a week with so many big policy changes?
Yeah, so that's a great question. I think the one thing that people have to bear in mind is there are big issues going on every week. There's always a story. We get distracted. So I think the most important thing is to have a plan, regardless of whether or not we're optimistic about the market or not. We need to understand what our liquidity needs are. We need to understand what our time horizon is, what our risk tolerance is. So having a plan is absolutely the most important thing. Having said that, if you want to get into very specifics here, with the market being relatively expensive. And again, we're optimistic. I'd say bleakly, we are guardedly optimistic at this point about what's going on. But if I did have money that I was going to put into the equity market here, I want to recognize the fact that the market's trading at a relatively high multiple, certainly relative to where rates are. So I'd want to take my time. Maybe I would want to dollar cost average that money over the next 10 or 12 months. We might get an opportunity here in the next 6 to 12 months. As much as I think Joe's 100% right on these tariffs, I think that Trump can use those as a negotiating device and maybe very effectively. If it gets away from a little bit and it becomes inflationary and it becomes a problem, we might have an opportunity to buy into the S&P 500 or lower level, in which case, if we are taking our time, we'll have an opportunity to buy stocks cheaper. So I would say work your plan. If you are anxious to get some money to the market, look, getting 5% in that money market account while we're waiting to deploy that cash is not a bad thing. Take our time, look for spots to get into the market at a lower rate. I think that's the way I'd be thinking about it right now.
No, I couldn't agree more. You don't want to follow the crowd.
Right.
And if the crowd is all rushing, telling you to invest, try to overcome your greed by thinking about the fear of what happens if I get in, put all my money on, and the market drops 20. And I think often people think in a binary way, I'm in or I'm out, which is basically market timing. That's never, ever works, because it requires the right decision of when to get in and when to get out, and if you get out, when to get in again. It never works. So it is much more important to do a measured approach, just like Scott outlined. If you decide you want to get invested, take time with it. Do 20% now. Wait a month or two. If the market falls 5 or 8% when you'll be saying, I should be getting out, go and add your next 20%. So again, time is your friend here. I do think, even though the market will probably be a little higher by year end, it's going to be more volatile than it was last year. We've had unusually low volatility the last couple of years. It's very rare. And there's a lot of reason with high interest rates, with very high multiples, to see more volatility this year. And I think you just need to be thoughtful about how you invest or reduce your equity exposure.
Yeah, sometimes volatility can give us opportunities, right? And I know what you guys are really saying, because I like to shop, right? And I like to shop when things are on sale. And so there's always opportunity there. I know you two may not do a lot of shopping, but I do look for...
I have 3 daughters and a wife who all love to shop. So I have no choice but to at least fund the shopping expeditions.
That's right. But I think what you said, time is on your side. We have time to do this, and the fundamentals are there. So let's go on to our second viewer question. There's been a lot of talk about bonds versus crypto versus equity. Joe, I know you've been looking at this all week. What are your thoughts?
Well, look, I always look in frothy markets. Are there marks of bubbles? Do you see bubbles? In 2021, when the NASDAQ stocks were going completely crazy and tech stocks were going completely crazy, at the same time, we had the surge in what were SPACs. And SPACs were, at that time, we also had the NFTs that everyone was buying. SPACs were these vehicles that allowed you to buy into a portfolio company that would buy other companies. And every celebrity seemed to be launching one. At the same time, there were NFTs, which were digital pieces of art that people were buying. It was one for $69 million that have all collapsed. Many of those SPACs never went to public. Many of them fell 80, 90%. Same thing happened with NFTs. What's happening right now with meme coins is very scary, because it's a marker of just abject speculism. It happened with meme stocks. Now we have meme coins. And our own president launched a coin that within a few days, even after a huge decline, at the end of yesterday, was worth $8 billion. And the president and his family own 80% of that coin, which means that 20% was sold at prices above $8 billion, which is great for the people issuing the coin. I don't know if it'll turn out to be an investment, because it's not even an asset. There isn't even the potential of a potential business behind that. I noticed the First Lady's coin is, as of yesterday, worth $700 million after a 60% decline from the peak. So even the pastor who inaugurated the president is now launching a coin. Yeah. When you see that kind of activity, just be careful, because again, if you do it as a hobby, you want to have fun, great, but don't put your life savings. I saw the Hawk Tour go. People lost millions of dollars on that. These are purely speculative. There's no underlying asset at all. It's a marker of the amount of speculation and greed in the market right now, which to me is a red flag. We know what happened in 21. Tech stocks took a big tumble right after all that speculation. And so again, those are the kinds of things that you look for near the market peaks where you say, are there signs of people being way too greedy? And again, I'm not making any aspersions to anyone issuing the coins. I just think you want to be, as an investor, which is what we're here to do, protect you. Be very, very careful. Don't put any serious money in anything that doesn't have asset value so you can track and measure and have real asset value underneath. So again, I think you just have to be very careful here. And a lot of people are, hey, we didn't get it in Bitcoin. Let's just go get it with this other coin. And it's basically a greater fool theory. Will somebody else pay me a higher price than I paid for something that's not worth anything? So I'd be very careful. Would I choose stocks or bonds? Yes. Would I choose Bitcoin? Maybe. Would I choose meme coins? No. So again, stocks and bonds are both valid investments. As is always the case, look at your overall risk profile before you choose either. Like, how much risk are you willing to take? And then make the decision on the context of your risk tolerance. And then over time, get to that target allocation. Right now, people probably have too much in stocks. They probably want to rebalance, which means investing a little bit more in bonds, which have pulled back a little now, probably in the 4.5%, 4.4% on a 10-year, just down from 4.8. And so if you had bonds, you had a nice rally this week. So again, I think just being calm, do not get swept up with crowds. Crowds make really bad decisions.
Yeah. This is one of those conversations people have, over cocktails, and everyone wants to tell the story. Well, when you lose everything you put into a meme coin, that's not a story you want to tell at the cocktail hour. So just always know what you're willing to lose as you go through this, right?
To your point before, though, I think as people are thinking about what's going on right now and talking about stocks and bonds and crypto, and there's a lot of noise out there about crypto. And I think there's a conversation to be had on Bitcoin. Again, that's a longer conversation than we had time for today. Maybe something to talk to your advisor about. But I think with where rates are right now, again, at Bleakley, we look at bonds for what they are. They're for income. So we have a conversation every day with clients who have, retirements to plan for, and, setting up bond ladders where we know that we have a certain income stream coming in. And if I can get a 475 or 485 yield, in a bond portfolio, that's great. Equities are more long-term. So again, if we've got long-term money, we want to be in the equity market. But there are some areas of the equity market right now that haven't had nearly as big a run-up as like this Magnificent Seven stocks have. Mid-cap stocks seem relatively good value. Healthcare is a relatively good value. In fact, at the end of last year, with all the noise around Robert Kennedy, coming in, what the administration might do, the healthcare sector really sold off, I think, pretty unfairly. Typical fashion, everything got thrown out. So I think there are some opportunities out there in the equity market now, even with the S&P trading at such a high multiple. There are some places where we can go out there and find some good value. But I think, again, as long as you're long term, you're a buy and hold investor, you buy quality stuff. That's what you want to be looking at.
And again, what we've seen for 2 years in a row now is the S&P that's cap weighted has outperformed the median equal weighted S&P 500 by 10 to 15 basis percent each of the last 2 years. That typically speaks to speculation. So again, you could just be in mid-cap stocks, which I think is a very undervalued area of the market. I'm not as big a fan on small caps with high interest rates, but I do think the middle market, some of these underappreciated stocks that do not have the same level of valuations, that are paying you a dividend. Again, there's just ways to get invested that are more prudent than others.
That's right. And Scott, I'm glad you brought up the healthcare sector. We had David Mandelbaum on our show last week, and he talked about the opportunities there. So you as viewers, if you didn't see last week, I'd highly recommend you check that out with David's comments as well. But let's go to our third question now from our viewers. So should I be looking at AI and oil based on some of the things that President Trump said, or should I be reducing my position in green energy? Scott, would you like to share?
Yeah, there's a lot of talk out there about AI, and the way people have been expressing, that enthusiasm is buying NVIDIA and Microsoft and these companies. And they've been great, they've been great stocks up to this point. You could argue that they're getting a bit expensive. We think AI is here to stay. We think it's going to be a big part of the market. We think another way to look at opportunity, if you will, in that space is maybe to think about it differently. AI consumes a lot of energy. We think natural gas has a lot of opportunity. Pipelines. Look, we're going to have to get more engaged with nuclear power if we're going to power all this stuff. So, uranium, I mean, there are a number of places, but we think the energy space is interesting. You'd mentioned the new energy, space out there. A lot of people are very excited about windmills and, solar farms and what have you. That hasn't gone so well. We're of the mind that going forward, natural gas is probably going to be a big winner here. So, as you're looking at AI and you're looking at the amount of energy that takes, owning the energy space might be a good opportunity and a good way to play AI, if you will.
Great. All right. So really, this brings us now to what we should be looking for next week. And next week is another big week. Joe, you already mentioned this, but one of the first things we'll be watching for is the Fed releases its decision on interest rates. What are your thoughts?
Well, look, I think you've got everyone going from 0 to 25. I think the reality is they care more about what else is going to be happening. I think we're in a muted period. The Fed has told us they're not going to be aggressive. They want to focus on inflation. With the uncertainty in place, it's likely they just punt for one more meeting, don't do anything, signal that they've got an eye carefully on the markets. But I think what you're seeing is we've got some very important data next week coming out. And what I think you'll see is economy is doing quite well. Unemployment is quite healthy. There's not a big incentive to drop interest rates because, again, the reality is if things go sideways, if we get some negative surprises, having a high interest rate allows you to react very quickly without impacting inflation too much because our rates are still probably higher than they should be given what we're seeing. And they don't want to take their foot off the brake right now because the economy is doing remarkably well. And I'd just add, we don't know the impact on productivity of AI, but it will definitely have a massive impact. I think AI is as big as the internet was. But as we saw in the late 90s, the internet also went through lots of fits and starts. AI is as big an idea. It will have huge impact. You own AI if you own Coca-Cola. You own AI if you own General Electric. You own AI if you own almost any company in the US because they're all going to be using it. It's not really a choice. It will improve efficiency and productivity, but the Fed isn't going to increase rates, reduce rates now, I don't think, given nobody really knows where things are going to unfold in the next month or two.
Yeah, Joe, I'm glad you brought up AI. I mean, it is going to be a part of our DNA moving forward, but the other key component is just tech earnings next week. Netflix had surprisingly good earnings report. Its stock's up 10%. I know I'm contributing to that because I watch a lot of Netflix. So, and the Oscar, nominations.
What's your favorite, Terry? What have you watched that you liked?
Oh, a lot.
Putting you on the spot.
Well, there's a really good show that I've watched called Younger because, in my heart, I want to be younger. So that's been really, really good on Netflix. There's been
Can
a lot.
I tell you, I was on a plane. I watched the most embarrassing show that I had to turn off halfway, which was the Jerry Springer 2-part documentary. I didn't get past the first one because I was embarrassed for the lady sitting next to me. I'm like, I can't be watching this.
Yeah, I've been that lady sitting next to guys on planes, and it's not pretty, so I have to go like this. But anyway, so
we watch so much Netflix at home, my wife and I. And it's funny when Joe asked you, what are you watching? For me, it's like a joke, right? Or a good bottle of wine. And we like jokes and we like wine. But if you ask me, I can never remember it. You could tell me a good joke and I can never remember it.
Oh,
We
yeah.
watch so much Netflix. I'm telling you right now, I couldn't tell you the last 5 Netflix shows we watched. Right.
Well, I don't know if you guys have watched Diplomat, but that's got to be one of my favorites.
Very good. Yes.
And it's not coming out fast enough, in my opinion.
Very good show.
Yeah. One example. But Scott, my husband's name is Scott, as you probably know, and we enjoy a great bottle of wine with every Netflix show. One per show, one bottle of wine per show. No, just kidding.
Okay.
All right. So, but let's
just not be watching it at 3 times speed.
Yeah, that would be a problem. All right. So let's talk about Amazon, Apple, Microsoft, Tesla. They're all coming out with quarterly earnings. Scott, what are your thoughts?
I mean, it's hard to say anything negative about those companies. They've been so amazing. There were a lot of people that, bet against Tesla, even 2 or 3 years ago, because they were looking at them as a car company and, scratching their head, how can this company be worth the whole automobile industry, market cap combined? And those people who shorted Tesla did it at their peril. Those companies are very expensive. Like Joe said before, they're priced to perfection. I think that, if they come out with really good earnings, they'll probably be okay. But I think that they're getting expensive. I mean, we're not loading up on those. Look, if you're in the Russell 3000 or you're in the S&P 500, you're getting a healthy dose of all of those names. So I don't think I would necessarily want to go out and get more. Maybe something will come up and they'll be unfairly punished, in which case then, yeah, we might want to go out there and buy a little bit. But it's hard to chase Microsoft and Nvidia in these stocks at this level. They're very expensive.
And Terry, one thing we all know, there's the number they report, which is priced into the market, and then there's the whisper number that everyone's hoping they're going to hit.
Right.
All these companies outperform, usually by a very similar amount. If they don't outperform by their earnings estimates by enough, there will be disappointment because everyone's priced in them all beating their numbers. So everyone will say, oh my gosh, it beat its number by 10% and it's down 8%. That's going to happen several times next week, where somebody puts a remarkable number and the stock goes down. In order for you to exceed and go up on a day of reporting, you have to blow people away. And the problem is that that's happened over and over again. And the more that's happened, the more people expect it. So again, I would be surprised if we get earnings results that are so fantastic that it actually people are caught underinvested. Now it happens. Netflix showed us that this week. So it could happen. But again, as Scott said, don't chase it. Wait to see the reaction. Be invested in the market already. And that way you don't need to worry. And you'll be okay. You'll be participating in either direction. And you'll protect a little if it goes down because you're diversified.
Joe, when I worked at Charles Schwab as the head of retail, I had to give these quarterly reports as the head of retail. And I had a guy that led investor relations, and he would put his phone up when I got up on stage or went on camera, and he would watch that ticker go up or down. And when I would finish up, he'd say, okay, you're up. Like that's how closely they watch the analyst reactions to whatever we were saying. So that is really an interesting and high pressure job. So that's why I love this job so much. But there's some other big economic indicators that are coming out next week: GDP, consumer confidence, jobless claims, housing reports. What are we going to do with all this data, Joe?
Nothing. As I always say to people, there's information. And you have to decide, is it interesting or is it important? And really, most of this is interesting, but it's not that important. And again, unless it's something really surprising, it isn't going to make a huge impact. It's just part of the entire flow of information that is really going to determine what the Fed does. Now, that's the only thing that really matters. And so again, it's all interesting. It's not that important. Now, the media does make a point of trying to make everything seem important and like you need to go do something right now. Guess what? You don't. It can still be interesting. You can still talk about it at a cocktail party or read about it in the newspaper, but don't do anything because the reality is it's too late for you to do anything about it. By the time you've read whatever it is, it's already priced into the market. And always just remember, the stock market is an anticipatory mechanism. So unless you know something that is not already in the numbers, which most of us don't, even at the smartest, highest levels, you just don't try to guess where things are going and just be invested and prudent.
I like that. Investment and prudent, and you have time on your side. I love that advice for our viewers. And that really wraps up our show today. I really wanted to thank you all for participating today. I encourage you to go out on the website, subscribe, share questions with us, share ideas with us. We really want to hear from you. Just like we had 3 questions from viewers today, we'd love to hear your questions next week. Thank you so much, Joe and Scott.
You bet. Have a great week.
Nice being with you.